Hello, this is James and Hussein from Merit Accountants, incorporating the accountancy people. In today's episode, we're going to talk about the employment allowance. We do regular updates on tax and accounting issues, so if you want to be kept up to date, please subscribe to the channel, and if you press the like button, it helps us and it helps the channel to get to more people. So, Hussein, the employment allowance. So what is the employment allowance?
So the employment allowance is an allowance that businesses get which offsets against their employer's national insurance liabilities. And it's currently set at £10,500 per annum.
So it reduces the amount of employers' national insurance that they pay by £10,500.
Yes.
Okay, and who gets this allowance?
So almost all businesses get this allowance except for businesses that operate in the public sector, single director only companies, and also companies within a group or connected companies. Only one company would get the allowance.
So just one company in the group, not public sector employers that work in the public sector for the public sector, and one director company. So are there any, because that affects quite a lot of our clients.
Yes.
So tell me a bit more about that.
So a single director only company is where there is only one director on the payroll, and these companies are not eligible for employment allowance.
So there's one director and there's no other employees.
Yes,
Right.
and what that means is on a salary of £1,000 per month paid to a single director, employers national insurance of £88 odd a month would be due, which equates to roughly over £1,000 per year. However, if it is a husband and wife company where both of them are directors, and if both of them are on the payroll earning above £416 per month, which is the secondary class 1 national insurance threshold, the company would then become eligible for employment allowance. And even where there is a single director company and there is an employee in the company earning above the £416 threshold, the company would be eligible for employment allowance. And there is no minimum employment period for the second employee or the second person on the payroll. They can be employed for just 1 month and the company qualifies for employment allowance for the rest of the year.
Yeah, so what you're saying, I think, is that if you pay yourself £1,000 a month, you would have a bill for employers' national insurance of £1,000
Per year, yes.
per year. But actually, if you paid somebody else for just 1 month for £416, just for 1 month, then you would avoid that tax bill. So it sounds like it's very attractive to pay somebody just for 1 month. Although I think if you are going to employ somebody, they always need to actually do some work.
Yes, that's correct.
So we should always comply with that.
Yeah.
So it sounds like although single director companies don't get the allowance, it's quite easy to allow them to have the allowance. Is that right? If you've got a single director company and they don't get the allowance, it's quite easy to change your affairs so that they do actually get the allowance by employing somebody else.
Yes, that's correct. And this is what we are currently doing for our clients. We are ensuring that our clients are eligible for the employment allowance and therefore saving them employers' national insurance.
That's good. So the perennial question is, should you pay yourself dividends and a low salary, or should you pay yourself a higher salary and lower dividends? Because if you're in a if you're in a family company, normally that is a choice to make. So how does this affect what you should pay yourself?
Yes, that's a very good question. And the traditional advice from all accountants has been that you would pay yourself a small salary up to the personal allowance, which is £12,500, and the rest would be taken as a dividend. However, because of the changes in dividend tax rates and the corporation tax rate, with the higher rate of corporation tax being 25%, in certain occasions paying a salary as opposed to a dividend is more tax beneficial because of the saving that the company generates from corporation tax by having a salary which comes off as an expense in the company.
And the real killer on that is employers' national insurance. So if you're not paying that because of the employment allowance, the whole equation changes.
Yes. Yeah. So if the company qualifies for employment allowance and saves corporation tax on the salary, in many occasions when you run the numbers, it is actually beneficial to pay a salary rather than dividends. For every client or for every business, it all depends on the numbers, and it's not a standard approach where small salary and dividends would work for everyone.
So I think that a key point here is that this is being filmed in November 2025 before the Chancellor's November budget. And what I think we're both sort of expecting is some of these numbers to move around during the budget, and we don't really know how they're going to move. But what we need to do then, we will be doing videos of that in the future, but also we'll be keeping an eye out for our clients on how that, do you pay dividends, do you pay yourself a salary, all of that pans out once we know the new tax rates. So if you like future updates, please subscribe to the channel, and if you like this video, then it helps us if you press the like button. So thank you for watching.
Thank you for watching, and we'll see you on the next video.